Daily Brief Canadian Macro with your host, Steve.
Welcome back to the Daily Brief Canadian Macro. I'm Steve. Canada just picked a German submarine builder for the largest defense contract in our history, and what it means for your portfolio might surprise you. Today, Ron Butler on the Carney Trudeau energy policy debate, Canada's new submarine deal, fresh Bank of Canada survey data on business confidence, and what's really driving the global oil market. Let's get into it. Ron Butler had a pretty direct take on Carney's recent comments about past energy policy. Carney framed Trudeau's carbon and natural gas policies as suited to the world of a decade ago, but wrong for today. Butler rejects that entirely. He argues those policies were flawed from the start, not just outdated. His counterfactual: without those restrictions, Canada could have built multiple pipelines and shipped around 10 million barrels per day, generating massive wealth through export terminals and oil sales we simply didn't pursue. Butler's core argument: this wasn't a timing problem, it was a categorical policy error from inception. That question of what Canada gave up on energy sits right next to a new bet the country just made on long-term industrial commitment. BNN Bloomberg covered Canada's selection of Germany's ThyssenKrupp marine systems to build 12 new submarines, the largest defense procurement in Canadian history. TKMS won on its Arctic-specific design and shared production line with Germany and Norway over South Korea's Hanwha Ocean and its faster delivery timeline. The Type 212CD was built for the Arctic from the ground up, a diamond-shaped hull to reduce sonar signature, hydrogen fuel cell propulsion for long dives without surfacing. Canadian companies also gain access to TKMS's broader NATO supply chain, a bigger opportunity than the contract itself. One flag: this is a preferred supplier pick and not a signed deal. Price, delivery sequence, and Canadian workshare will need to be finalized with a target end of 2027. Carney says the first 4 subs arrive by 2034, moved up from TKMS's original 2036, contingent on the previously mentioned negotiations. BNN Bloomberg also reported on new Bank of Canada data showing business and consumer confidence weakened during May's Middle East tensions and oil price spikes. Important caveat: those surveys were conducted in the first 3 weeks of May at peak instability. Oil prices have since declined and tensions have eased, so sentiment may have already improved. What's more telling is the forward-looking data. The share of firms expecting a recession nearly doubled from 9 to 17%, and companies are holding off on major investment until there's clarity on U.S.-Canada trade. Consumer spending intentions fell after 2 straight quarters of improvement, with households citing fears the conflict would keep pushing prices higher, persistent affordability stress. The economy's been surprisingly resilient through 2026, but real improvement hinges on those uncertainties resolving. BNN Bloomberg also broke down the oil market, and it is a supply story, not a production one. As many know, the Strait of Hormuz, not pumping capacity, is the real constraint. With flows resuming through the strait, prices have begun to decline from their peaks. BNN's framing: the market may stay oversupplied for months as traders rebuild inventory depleted during the conflict. Saudi Arabia has cut prices for Asian buyers as its output recovers. Current prices are insufficient for OPEC budgets, but barely support U.S. producer cash flow. An asymmetric setup where OPEC may cut production to defend prices, while U.S. producers slow growth instead of expanding. The bottom line: even with a fragile ceasefire, one incident near the strait can still spike risk premiums. The underlying supply picture points toward ample oil, not scarce. Butler argues Canada abandoned massive energy export potential through decade-old policy choices. The submarine deal shows the country making a different long-term industrial bet: defense capacity and supply chain partnerships with Europe instead. The BOC data shows business leaders in a holding pattern, waiting on trade and geopolitical clarity before committing capital. And the oil market outlook suggests that even with real fragility in the ceasefire, supply looks ample enough to keep prices contained, for now. Canada's at an inflection point. Past energy decisions casting a long shadow, near-term uncertainty keeping businesses cautious, new commitments like the submarine deal reshaping long-term positioning. Confidence won't improve meaningfully until those uncertainties are resolved. Well, that's the end of today's episode. Thanks for watching the Daily Brief. All credit goes to the creators featured today for their original analysis and insights, and you can find links to their full videos in the description below. If you found this video helpful, please subscribe, hit that notification bell so you don't miss our next brief, and don't hesitate to comment if there's a creator or topic you'd like to see covered here. I'm Steve, as always. Nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.